Well, hello everyone and welcome to Moementum channel. My name is Mo, and in this video, I want to provide a comparison of two fairly popular ETFs. One is XEQT, and the other fund that I want to compare XEQT to is indeed another BlackRock ETF with ticker symbol XWD, which is iShares MSCI World Index ETF. And the main motivation for this video actually comes from a recent post that I came across on Blossom. Somebody was asking about, a quick comparison between the two and which one probably they could consider. All right, why don't we start first and foremost with XWD? I've talked about it a lot less in the past, so we're going to get started with that. A little bit of a context of what XWD is intended to do. Through XWD, you are going to get exposure to large and mid-cap equities from developed markets, countries around the world. I want to point out here that the focus is on developed markets, countries. In other words, this is focused on developed international markets, including Canada, US, and other developed markets. It does not give you exposure to emerging markets. Just right off the bat, reading through that is already telling you that. The other thing is that the proportion of exposure to these developed markets are different from what you're going to see compared to XEQT. So I'm going to hover over to XEQT and just provide you what its focus is. With XEQT, it's intended to be more of a easy global diversification all-in-one solution. With XEQT, you don't actually need to buy additional stocks or ETF, really. And by only holding on to XEQT, you're already getting a diversified exposure to the entire stock market. This includes exposure to the US, Canada, but also exposure to the developed markets, similar to XWD. Besides that, you're also getting exposure to emerging markets. So for example, if I show you the underlying holdings, you see with XEQT, approximately 47% of exposure is to the US stock market, around 24% exposure to international developed market, excluding Canada and US, around 24% exposure to Canadian market, and roughly 5% is exposure to emerging markets. Now, if we compare that exposure to that of what is offered through XWD, here you have three ETFs as part of XWD that are underlying kind of ETFs. The first one, you see close to 71% exposure to the S&P 500 in the US. So focus is on S&P 500 in the US, not the total stock market, and 71% almost exposure there. That's quite considerable exposure to US stock market and only in the S&P 500 mainly. Then you have approximately 26% exposure to the international developed market. This is, I would say, very similar to the level of exposure that you got through, XEQT. If you recall, XEQT, you got roughly around 24%, here around 26%. Very much comparable. Exposure to the Canadian market is a lot less. It's only at 3%. And here you're only getting exposure to the top 60 Toronto Stock Exchange Canadian market, not the entire stock market, because with XEQT, you were getting exposure to XIC, which is for virtually the entire Canadian stock market. It seems like for XWD, the focus is a lot more targeted. So for example, for US exposure, which is a lot higher, you're getting exposure only through S&P 500 at 71%. For the Canadian market, the exposure is a lot less at 3% and only to the top 60 or so companies. And then lastly, you have exposure to international markets. The part that is missing for sure is, and in terms of one of the key differences, is that not having any exposure to emerging markets, the 5% that you got through XEQT, you're not going to get that through XWD. With XWD, your exposure is a lot higher to certain geographies, in particular to the US. The reason I bring this up is that it might be preferred for some investors, particularly those that always think that, they don't want to get overexposure to Canadian market. They tend to argue and bring up the argument that through XEQT we are getting too much exposure to Canadian market, given that the Canadian stock market only accounts for roughly 3% of the world economy. They think that with XEQT we are getting that home bias, kind of a too much exposure to Canadian market. The counter argument to that, and based on some of the research that Vanguard has done previously, because they do have a fund similar to XEQT called VEQT, their argument has been that the research has shown that having approximately that 30-ish% exposure to Canadian market allows for less volatility in the portfolio, and in the meantime, it doesn't really sacrifice the overall return of the portfolio. That's been some of the past research that Vanguard has done and published it, and I've talked about it in the past and included the link in the previous videos. I will definitely add the link in the video description. However, still there are advocates out there that believe that they would love to get a lot less exposure to Canadian market, around that 3%. If that's the case, XWD might be a good consideration for you. It's just that you're going to then miss out on that exposure to emerging markets. So if that was the case, you might want to possibly have some addition of ETFs that allow you to get some exposure to emerging markets, so that you don't totally miss out on those markets. Say you want to bring it up by 5%, so maybe you could add in there potentially a fund that you find within XEQT, such as XEC, which is actually iShares MSCI Emerging Market. Now let's just talk about fees as well. When it comes to MER, management expense ratio, for XWD, you're looking at a fee of 0.48%, close to 0.5%. Whereas the fee, if you compare that to what you are ultimately being charged for in terms of management expense ratio for XEQT, is a lot less than half, at 0.20%. We want to also take a look at the performance of these funds so far. Now, keep in mind the inception dates of these funds are different, so it won't be exactly apples to apples comparison. So we want to keep that in mind. The inception date for XWD goes back to June of 2009, so it's been incepted longer, whereas the inception date for XEQT goes back to August of 2019. So it's a lot more recent fund, and that's why when you're looking at annualized return for XWD, you do tend to see the 1 year, 3 year, 5 year, and 10 year annualized. But for XEQT, it hasn't been incepted at least for 5 years. That's why you don't see the annualized for the past 5 years. But we can try to see just how they've done, at least in comparative periods. So for example, for the 1 year return, at the end of February, the XWD showed a positive return of 24%. Really impressive return. Keep in mind that a lot of it has to do with the incredible return that the stock market in the US has had over the past decade. And given that you're getting a lot higher exposure to the US market in XWD, it's kind of reflected there. XEQT has been quite decent too, don't get me wrong. At the end of similar time period, 1 year return for XEQT has been positive 18%. Quite decent as well. 3 year return annualized for XEQT is at 8.9%, roughly, if you round it up, and for XWD is at 11.4%. Definitely, in this case, XWD has performed better over the 3 year annualized return. With XEQT, we didn't have other annualized return, but you can see at least for XWD, the 5 year annualized return is at 12% and 10 year annualized return of 11%. If you go back, its return annualized since its inception, as we said back in 2009, it's at 11.9%. For XEQT, its inception since 2019, annualized is showing at close to 11% as well, 10.9 to be more accurate. And that's something for you to keep in mind. Lastly, I want to touch on the aspect of any dividend that you receive. With XEQT, you do receive a dividend distribution on a quarterly basis, which is roughly hovering around the 1.9% yield at this point, annualized. And if you go back to XWD, I'm just going to quickly show you, its dividend yield is less. It is actually, I believe, close to 1.3%. Yes, as you can see, and it's only paid on a semi-annual basis. Again, this might be desirable for some investors that don't like to get paid in dividend income and rather have their funds to continue to grow and essentially have it reinvested. For those who are investing in XEQT, you could still actually make sure to reinvest the funds back into the same shares, or maybe use it to buy other shares again, and allow that compounding to happen again. All of these kind of ETFs allow you to actually invest through a DRIP or dividend reinvestment program. So that's not something that you have to worry too much about. Let me know your thoughts. Which one of these two funds are you more interested in, and you think that is better pick for investors? I would love to hear from you. Leave me a comment down below. Thank you so much, everyone, for watching this video until the end. I hope you found it beneficial. If you gained value, don't forget to smash the like button and subscribe to our channel here on Moementum Finance. We post weekly videos about investing in the stock market, mainly investing in passively through index funds, but also discussing ways to reach financial freedom and financial independence. Thank you, and I hope to see you all next time.